Hello, this is Professor Zera again. And as promised in class, I'm going to put up the video. This is going to help you with the final of the lecture that I did on Tuesday, December 8th. A problem I did, which I call the pre-final problem to help you with the final. It's very much like the final. I've changed a couple things to see if you're understanding a couple things. But as I go through it, it should be pretty much like the final. So I'm going to start the problem now. There's going to be 4 videos, which I'm going to connect to the final folder. It'll be on YouTube. Okay. Palm acquired 90% of the outstanding voting common stock of Sun on January 1, 2016 for $15 million when Sun's stockholders' equity consisted of $500,000 common stock, $5 million capital stock, and $2 million of retained earnings. The price reflected a $500,000 undervalued inventory and 3.5 undervalued building with a 7-year life from January 1, 2016. Okay, and then additional information. These are the intercompany transfers. PAM sells inventory to Sun on a regular basis. Those are downstream, obviously. All right, just sub. During 2019, PAM sold $1 million revenue to Sun of inventory. The original cost of the inventory had been $600,000. The deferred gross profit of this inventory was $100,000. That's during 2019. This happened, and so this is going to be a 2000. If you look at number 6, there's going to be a 2020 consolidation. So this is a 5th-year problem. The transactions are started. The acquisition took place on 1/1/16. The consolidation is for 2020. So that means you have 2016, 17, 18, and 19 before this year. 4 years before this year, and this year is the 5th year. So there's a 5th-year consolidation. Okay, so that's the first one. And then during 2020, there was another transfer. That 2020 is the gross profit on going to be the current inventory, the ending inventory, because that's this year. During 2020, PAM sold inventory to Sun for $1.5 million revenue. The original cost was $900,000. The deferred gross profit was $120,000. Okay, then number 2, you have a land transfer. That's a downstream land transfer during 2017. That was like 3 years ago, 3 or 4 years ago. PAM sold land. Yes, it's downstream that cost $1.5 million. It cost $1 million to Sun for $1.5 million. So that's a downstream transfer of land 3 years ago, the $500,000 gain. And then number 3, Sun sold equipment with a net book value of $100,000 to PAM on January 1st, 2020. So this is this year, and this transfer is upstream. Okay, so here's what you're gonna have to do. Let's in this video I'll put up the preliminary, let's call them, and then the next video I'll do the calculations, all these 3 calculations here. Then I'll do the journal entries, and then I'll finish with the consolidation. Okay, so 2019. Read piece of information number 1. Read the information during 2019. Piece of information number 1. PAM sold. The problems, the statements are in thousands, so I'll just keep it in thousands. Inventory items. With intercompany transfer revenue of $1 million to Sun. The original cost of the inventory was $600,000. Deferred gross profit was $100,000. So the sales on the beginning inventory downstream were $1 million from parent to sub. Deferred gross profit is $1 million. Now the ending inventory is what took place this year, which is 2020. This is inventory on which the parent sold to the sub this year, and which the sub had not sold to an outside third party at the end of this year. Okay, so it says, during 2020, I'm reading information number 1, their additional information number 1. During 2020, PAM sold to Sun $1.5 million revenue of inventory. What else would it be? Original cost of the inventory of $900,000, and the deferred gross profit of the inventory was $120,000. Okay, so the revenue here is $1,500,000. I'll leave the final zeros off, and then $120,000 is deferred gross profit. Okay, now we move on down to the land transfer, number 2. During 2017, so that was 3 years ago, PAM sold its downstream a piece of land to Sun that cost $1 million that PAM had paid originally $1 million for, and was selling to Sun for $1.5 million. So this is a 2017 transfer. Okay, and the price that was paid, that was charged by PAM to Sun, is $1,500,000. The original cost to PAM had been $1 million. So the gain is $500,000. Okay, and so you don't have to worry about depreciation. It's land, but be aware that there's two items that took place before this year, two intercompany transfers. The beginning inventory right there, and then this land transfer. So always keep track. When you're doing intercompany items, always keep track of things that took place before this year, because those are going to be the ones that are sitting in your investment account, in the beginning balance of your investment account. On down a little later. Okay, finally, now this is this year, 1/1/20, so it could not have been in your beginning balance. Anything that takes place this year can't be in your beginning investment balance. Okay, so on 1/1/20, I'm looking at number 3 here, 3 right there. This is upstream, and that's why I put this as upstream. Sun sold equipment with a net book value of $100,000 to Pam on 1/1/20 for $600,000. This is upstream. So you need to calculate two things that are going to throw your current income off. One is the gain. S is going to record a gain on this transfer. And then the other one is that you're going to have the P is going to be recording too much depreciation. Let's get this gain down first. 1,600,000 is the gain, or is the price that Sun charged Pam. Okay, but it's intercompany transfer. You can't recognize the price, the proceeds on a sale to yourself. It says that the original net book value right there was $800,000. I'm reading additional information number 3 minus $800,000. Okay, so that's going to give you $1.6 million plus $800,000 gives you a gain that shouldn't be there. S's gain of $600,000. Okay, and then finally we need excess depreciation. And here's where I'm going to emphasize something. And if you don't see this video, and I emphasize in class, but if you don't see this video, then you'll miss something. If you have a gain, you're going to have excess depreciation. Why? Because in this case, or in any case when you have a gain, upstream transfer is the sub sells it to the parent. The value of the equipment on the sub's books is $800,000. The sub wipes it off his books, and then the parent records it on his books for $1.6 million. So in a sense, you've just arbitrarily written equipment up from $800,000, $1.6 million. So that means when you write up any asset, you're going to have excess depreciation in future years. And so that means on gains, when you have a gain on the sale, you're going to have excess depreciation. So you're going to have to back it out in the consolidation. However, when you have a loss, you're writing the asset down, which is going to mean you're going to have too little depreciation, which means you're going to have to add depreciation back. So remember what I'm telling you here, folks. If you have a gain, you're going to have to get too much depreciation, and you're going to have to back out the depreciation in the consolidation. If you have a loss, you're going to have too little depreciation, and you're going to have to add that depreciation back in the consolidation. So here we have a gain of $800,000. Let's assume that this has a 4-year life, and I'm going to put this in here if it doesn't mess me up. The equipment has a 4-year life. Okay, so I'll just go with that. Okay, and so the amount of your excess depreciation is equal to $800,000 divided by 4 gives you $200,000 of excess depreciation. Now, since this happened, I'm going to finish this video now, but since this happened this year, then S's gain should be on S's income statement. So let's go down here and see if it is. There it is right there. Gain on income statement. And you're going to back that out to make it 0 in the consolidation. Okay, I'll finish this video and then I will post it. There's going to be 4 videos total. I have finished this video and I'll start the next one in a second.